and second day of July 2020. And from the stable of WebTV, we bring you the incisive and engaging economy and politics show. Here are the following stories and reports we have for you this morning. The PPRA announcement on the adjustment of the PMS price, announcement of the reopening of domestic flights in Nigeria, report on the active voice subscription in Nigeria for first quarter 2020, the analysis on Nigeria's oil sector, the Cbn Six Steps response to COVID-19, FBN Quest Research Nigeria manufacturing PMI analysis, Airtel Nigeria CEO's advice to SMEs to invest in technology, and United Capital's first half of the year's reports and second half of the year outlook called Up in the Air. But before we begin, let's take on the economic indicators we have in Nigeria at the moment. Inflation is currently 12.26%, but is projected from our analysis to 14.7% at the end of the year. Apart from inflation, the other indicators are growth rate, which is 1.87% currently at the moment, and it's viewed that it may end at minus 3.32% at the end of the year. Exchange rate reserves, in terms of our reserves at the moment, are $33.34 billion, and may at the end of the year, in terms of projection, close at $27 billion. Unemployment rate is still high at 23.1% and is projected to spike to 43.8% at the end of the year. Current Brent crude oil price is $31.46 per barrel and is expected to tilt down to $25 per barrel at the end of the year. Our current interest rate is 12.5% and is projected to hit 13% at the end of the year. The exchange rate in terms of naira to dollar value is 261 currently, but could hit about 458 at the end of the year. And in terms of our total public debt, the debt that we're owing totally is 25.7 trillion, but that could hit 30 at the end of the year. Cash reserve ratio remains 27.5% and is projected to hit 30. These are sourced from Bloomberg, Central Bank of Nigeria, ProShare, National Bureau of Statistics, and that is an interesting economic indicator that will continue to bring to you in the course of this show. Now let's begin with the story, major story that came out yesterday, story that a lot of analysts, economists, and people have been talking about in the country. The story that the Petroleum Pump Price Regulatory Agency announced a new price regime for the petroleum motor spirit, PMS, in a statement published yesterday. According to that statement, it said, please recall the provision for the establishment of a monthly price band within which petroleum marketers are expected to sell PMS at the retail stations based on the existing price regime. After a review of the prevailing market fundamentals in the month of June and considering marketers' realistic operating costs as much as practicable, we wish to advise a new PMS pump price band of 140 naira 80 kobo to 143 naira 80 kobo per litre for the month of July 2020. According to the statement, the PPRA said, kindly note that the ex-depot for collection includes the statutory ENA charges of bridging fund, marine transport average, national transport allowance, and the administrative charge. The PPRA said all marketers are advised to operate within the indicative prices as advised. And that is the latest news and development which will bring you reactions to this in the course of our show. After 3 months of closure due to adverse effects of the COVID-19 pandemic, activities in the Nigerian aviation sector will begin to pick up. And this is because the Honorable Minister of Aviation, Senator Captain Hedi Serika, announced yesterday night the resumption of domestic flight operations in the country. That is good news for travelers. Quoting from his Twitter, he said, I am glad to announce that Abuja and Lagos airports will resume domestic operations on the 8th of July 2020. Kano, Port Harcourt, Owerri, and Maiduguri are going to resume on the 11th of July 2020, while other airports will resume on the 15th. For the international flights, he said dates will be announced in due course and urge all Nigerians and populace to please bear with the Ministry of Aviation. With this information, domestic flights across the country will commence which means a resumption of activities for an industry that has been severely hit by the COVID-19 pandemic. Let's go to telecoms, and we all know how Nigerians are very, very engaging when it comes to telephones and internet. The telecoms data for first quarter 2020, published by the National Bureau of Statistics, reflected that a total of 189,282,796 subscribers were active on voice, as against 184,699,409 in fourth quarter of 2019, and 173,713,842 in the first quarter of 2019. This represented 2.48% increase in voice subscriptions quarter on quarter and 8.96% year on year. Similarly, a total of 136,203,231 subscribers were active on internet, as against 126,078,999 in fourth quarter of 2019, and 116,210,154 in the first quarter of 2019. This represented 8.3% growth in internet subscriptions quarter on quarter and 17.10% year on year. Lagos State, Nigeria's economic capital, had the highest number of subscribers in terms of active voice per state in the first quarter of 2020 and was closely followed by Ogun and Kano states, respectively, while Bayelsa and Ekiti states have the least number of subscribers. Similarly, Lagos State had the highest number of subscribers in terms of active internet per state in the first quarter of 2020 and was closely followed by Kano and Ogun states, respectively, while Bayelsa and Ebonyi states have the least number of subscribers. So you hear Lagos highest in internet and voice, Bayelsa lowest in internet and voice. MTN had the highest share of voice subscription. MTN continues to dominate, and this was closely followed by Airtel, Globalcom, EMTS, and others. Similarly, MTN had the highest share of internet subscriptions and was followed by Globalcom, Airtel, EMTS, and others. That's interesting to get insights from what's happening in the telco sector. Now let's move on to the oil sector. From the stable of ProShare, Nigeria's leading financial information hub and Chronomics report, here's a summary from the oil sector. It says the oil sector is one of the hardest hit sectors of the economy, as we can see across the globe. Despite the negative effect of the coronavirus on the oil sector, the sector recorded a growth rate of plus 5.06% in first quarter of 2020, which was a major driver of our economic growth that is currently 1.87%, an improvement from a growth rate of minus 1.46% in the corresponding quarter of 2019, and a decline from the growth rate of 6.36% recorded in fourth quarter 2019. The pandemic led to a fall in global demand for oil and oil prices. The intervention of OPEC Plus and top oil producing countries through the output cuts has still not impacted significantly on oil prices or stabilized the market. The oil price actually recorded fluctuations. Now, if the pandemic lingers on, according to reports, the Nigerian oil sector is predicted to contract further in the remaining quarters of the year. Let me just summarize this. If that happens, definitely we are heading for a recession, because at the moment, the oil sector remains the driver of Nigeria's economy. And that is something that policymakers and all stakeholders will look at. And so, based on that, you can now understand all the companies operating in the oil sector are going to go through their own phase of challenges in sustainability and survival this period. Now let's look at the Central Bank of Nigeria. Has been the busiest through this period, really busy. Now, according to the ProShare Economics report, it looked at how the Central Bank has responded in terms of the COVID-19 pandemic and its steps taken and what are the imperatives. Now, against the background of central banks across the globe, cutting interest rates and buying back domestic treasuries, T-bills and bonds, like treasury bills and bonds, Nigeria's central bank recently announced a 6-step policy initiative to head off a recessionary dip as the coronavirus pandemic takes a toll on global economies and threatens to lead them into a recessionary spiral. The Cbn Six Policy Steps include the following, and it's important that viewers listen carefully. Temporary and time-limited restructuring of the tenor and loan terms for businesses and households. This should create stability of the lending sector, as disruptions to business would make repayments difficult, thereby increasing the non-performing loans, NPLs, of the sector, which had gradually started sliding towards the CBN required rates per bank of 5% or less. Cutting down of interest rates on intervention programs from 9% to 5%. The rate cut on intervention fund would cushion the adverse consequence of business disruption that would likely result from production closures, supply chain disruptions, and demand collapse as social distancing and restricted movement lead to lower domestic consumer and producer spending. A $50 billion targeted credit facility, which will be expected to assist in creating liquidity in the domestic credit market. The support of the credit market with an additional 50 billion naira may prove inadequate to repel a recession, as it would not address the tricky problems of supply chain disruptions, rising domestic inflation rate, that's reduced real consumer spending power, and the rising risk of lending into a declining domestic economy. Now let's look at the regulatory forbearance. This will mean that the CBN will ease enforcement of the strict rules around advancing credit. The relaxed enforcement regime will allow the bank give customers breathing space to repay loans without suffering heavy charges against their profit and loss accounts by way of impairments. In other words, the CBN will hope to keep the financial system, particularly the credit market, stable. The move is commendable, but may not achieve much, as the problem will remain the lack of production throughputs to create sellable goods, which in turn will generate revenues, profits, and free cash flows. Strengthening the loan-to-deposit ratio, the LDR of banks, looks obscure. The CBN raised LDR twice in 2019, and banks are still struggling to meet the recent 65% ratio. Pushing banks to lend further in a recessionary environment could adversely impact the industry's falling non-performing loans. Support for healthcare industry, according to this report, is a brilliant initiative, except for the fact that if healthcare companies cannot import critical inputs to manufacture drugs, no matter how low interest rates fall or how much credit they can get, the financial situation of pharmaceutical companies may not improve significantly. To get pharma running, supply chains need to be restored and effective demand of consumers augmented. And I can buttress that, but just to let you know that in our interactions with CEOs of pharmaceutical companies, they've said that the issues of FX, they should be given priority, and also fiscal policy should review the issues of VAT on raw materials for pharmaceuticals. So those are very important things that the fiscal and monetary policy should look at if the intervention from CBN will really impact pharmaceuticals. And all Nigerians know how important pharma companies are now, because if we support them, if government supports them effectively, and they can bring out vaccines to cure and reduce the impact of COVID-19, we can really resume activities fully. In addition to its 6-step policies, the CBN announced a 1.1 trillion naira intervention fund to support critical sectors of the economy. Note that this is channeled into the 2.3 trillion naira stimulus of the Economic Sustainability Plan. The CBN governor in a recent statement noted that about 1 trillion naira will be used to support the local manufacturing sector, as well as intensify import substitution. The remaining 100 billion naira will be used to support the healthcare sector, where pharmaceutical companies and other health-based companies can access funds to provide innovation and research, work with scientists around the world to patent and produce vaccines and test kits for issues and diseases like COVID-19 and other related ones. Those are analysis and views on the Cbn 6 steps, and it's important that the Monetary Policy Authority takes note of this and makes necessary steps going forward. Now let's look at the trade sector. The trade sector had been a very important driver of growth for our economy, and let's look at how the analysis from the Chronomics ProShare report takes it up. The trade sector had contracted by 2.82% in the first quarter of 2020. It contracted from minus 0.58% in fourth quarter 2019 and 0.85% in the corresponding quarter of first quarter 2019. The trade sector was adversely affected by the global spread of coronavirus. Note that this pandemic has brought huge trade restrictions. The restrictions in international travels, as well as interstate travels, disrupted the supply chain and distributional efficiency of almost every sector. The growth of the trade sector was further worsened with the decline in consumers' demand, the volatility of the foreign exchange market, as well as dwindling oil prices. It is forecast that the trade sector will contract further in the second quarter and will gradually recover in the fourth quarter, while full recovery is expected in 2021 as the economy is fully opened and the virus is effectively managed. That's nice to hear, but there are two conditions. Again, if it is fully managed, the health pandemic, and of course, economic policies are working. Let's go on a break, and when we return, we'll give you further updates on our storyline for today.
If you want to summarize the entire change within the finance side, the way I summarize it is that we are beginning to make a policy shift from direct tax towards indirect tax. And that's in alignment with the national tax policy for many reasons. Indirect taxes are easier to collect. That's your sales tax, your customs, and all of those transaction taxes. Many of us this morning have paid VAT on a number of transactions. It may be transport, maybe Uber, maybe food, in the hotel, in the restaurant. So it's very easy to get revenue from indirect taxes because the collecting agents are fewer. All of us, as we transact, we pay those VAT, and it's only one vendor. Maybe perhaps of the over 500 or 600 of us seated here, maybe the number of vendors that needed to account for those VAT are just 50. So the administrative burden of chasing after so many collectors is fewer. That's one. The other reason that makes this very pleasant for me is that in an economy where we recognize the fact that there is need to reflate the economy and keep money in circulation, what you do is to reduce taxes on companies and taxes on individuals, increase disposable income, and those disposable income is then plowed back into the economy. And whatever you are losing in the short term from the reduction in direct taxes, you gain on the indirect taxes because the propensity to consume is very high. Some economists say it's as high as 0.8. So for every 1 naira you have, you probably will spend 80 kobo. And for each spending, there is a tax point. So this Finance Act made some changes that align with that direction. As corporates, whether you're running business or you're in charge of regulation, you must recognize that if you fail to anticipate and sense the changes that are happening around, you may be running into troubled waters. The kind of headwinds and tailwinds happening from global to Africa will continuously require responses from government. And that responses will often trigger increasing block compliance leakages. If it is difficult to raise the revenue and it is increasingly tough to preserve the bottom line, you want to avoid as much as possible every unwanted extra cost that is attendant to non-compliance. In 2019, fines and penalty was an income line item in the budget of the federal government. You don't want to be one of those. Of course, create a response mechanism so that as the regulatory pressure intensify and continue, you can continue to run your business and keep your business afloat.
Welcome back. Let's continue with our conversation today around developments and reports that we have on Nigeria's economy. Just to give you a recap, that the Petroleum Price Regulatory Agency, PPRA, has announced a revised price for PMS around 140.30 naira per litre. Also, that the Minister of Aviation, Senator Captain Hedi Sirika, has also announced the resumption of domestic flights for Lagos and Abuja, which will begin on the 8th of July, and other airports 11th and 15th. But that will be international is coming soon. They will announce the modalities soon. And we've been giving you analysis on the Nigerian oil sector and also the 6 steps of the Central Bank of Nigeria in response to the COVID-19 pandemic. Those are some of the developments and stories analysis we've been giving you. Also, the analysis on the trade sector, which has contracted and is projected to recover provided the management of the pandemic is effective for the country. Let's get on to FBN Quest Research, which recently published its analysis on the Purchasing Managers Index, which featured on ProShare. One of the major indicators for manufacturing sector is, of course, the PMI. And according to its report on the manufacturing PMI, the first of its journey in Nigeria surged from 43.3 points to 53.9 in June. Its partner, NOI Polls, had compiled the data. The index can be found in advanced economies such as ISM in the US, larger emerging markets like China, India, and Russia, and some other frontier markets. It is based on responses to set questions on core variables in their businesses, and in the case, it is not seasonally adjusted. The highest reading was 68.7 for Nigeria in December 2017, and the lowest recorded now is 43.3 in May 2020. In the unweighted model, that of the Institute of Supply Management, respondents were asked whether output, employment, new orders, suppliers' delivery times, and stocks of purchases have increased over previous months, changed, or have declined. A headline reading of 50 is neutral, and anything higher points to expansion in the sector. The sample of respondents is a representative mix of small, medium-sized, and large companies across the 6 geopolitical zones of the country. PMIs, unlike the national accounts, are forward-looking indicators with a proven record of moving financial markets in advanced economies and the largest emerging markets. There have been some particularly large monthly swings of more than 10 points this year due to COVID-19. The changes in the index have been subdued in comparison. The full lockdown was uneven across the country and shorter in duration than in most advanced economies. Also, Nigerian manufacturing broadly produces for the domestic markets, so has been less buffeted by weak external demand. All of the 5 sub-indices recorded increases. The surge in the headline reading can be largely attributed to the phased easing of lockdowns and controls on movements restrictions across the country. Note that curfews were relaxed in June, allowing businesses to increase their operational hours. FBN Quest notes that demand has picked up at the moment. However, consumer confidence remains subdued. The decline in foreign exchange availability remains a negative for the manufacturing sector. The Central Bank of Nigeria has not supplied the investors and exporters window, I&E window, since late March. As at end of June, the FX rate in the I&E window was 387 naira to $1, while 3 of the 5 sub-indices were above 50, including output, prominent among the responses to the trigger question for the increase in outputs, are better access to raw materials as well as visible pickup in demand. Due to the partial easing of lockdowns and the relaxation of curfews, the employment sub-index recorded marginal increase. That said, the current macroeconomic environment remains hazy and is unlikely to encourage aggressive business expansion. On a 12-month moving average basis, the headline index rose marginally from 51.5 to 51.8 points in June, a little above average and room for more expansion in Nigeria's manufacturing sector. Now let's look at business and prospects amidst the pandemic. In adjusting to the new normal, business owners and operators of the small and medium-scale enterprises have been advised to invest massively in technology and also find ways to source their raw materials or supplies locally, as this is expected to boost their activities and help them stay afloat, especially in the wake of the COVID-19 pandemic. This was the view of the Managing Director and Chief Executive Officer of Airtel Nigeria, Mr. Segun Ogunsanya, who gave these tips at a recent United Bank for Africa quarterly business series, which was published on ProShare. According to him, it's important that businesses redefine their activities to adapt to the new normal which most economies have found themselves as a result of the raging virus. The UBA Business Series, which was organized by Pan-Atlantic Finance Institution, United Bank for Africa, is a capacity-building initiative held every quarter where leading business leaders share insights on best business practices and how entrepreneurs can build a sustainable business empire, especially in challenging business environments in Africa. The edition was moderated by the Chief Executive Officer of Limited Consulting, Bankole Williams. Ogunsanya took time to give an insight to the strategies and competencies for adjusting to a post-COVID-19 business environment. He sought to equip business owners with the important and essential strategies of how to recover and rebuild their business concerns following losses incurred due to the pandemic, which could take the whole world, and it has already done so, by storm. Many businesses are now re-examining their models and strategies in line with the new normal. Giving the essential strategies to business owners on how to help their businesses thrive and stay afloat, Mr. Gunsanya said, "I must stress the need for business owners to invest in technology as is very key in the new normal to ensure that our employees are able to deliver the goods and services to customers while remaining safe and keeping the customers safe also. Remember that the customer is still the king. So it is important to ensure that you configure all your operations to make sure that they are still able to transact their businesses and also encourage online payment for service because handling cash can also be dangerous. More importantly, look for ways to configure your businesses to what your customers actually need, especially in this era of physical and social distancing." While giving examples of companies that have changed the direction of their businesses due to limitations occasioned by COVID-19 pandemic, Ogunsanya told the over 2,000 participants at the webinar that this period called for critical evaluation of businesses where SMEs should think of creative ways to ensure that they meet the needs of customers and provide services that customers are actually willing to pay for. According to him, if as a business you find out that a huge part of your key services are not in high demand as a result of the lockdown rules, then it's important to reconfigure your services. Find other needs that you can meet for customers, look for various things you can do differently, completely cut out waste and costs that are irrelevant, as well as areas where value is not being added to the customers, and ensure that you have a digital roadmap, he said in response to participants' interaction. For UBA's Group Head, Consumer and Retail Banking, Jude Anele, who spoke ahead and giving insights into the webinar, he said UBA is interested in ensuring that customers and entrepreneurs run businesses that can stand the test of time, adding that the business series seeks to arm business leaders with all the knowledge and experience required to take their businesses to the next level. That's where everybody wants to go, the next level. And speaking about the next level, let's go to the United Capital report. Now, United Capital always gives us insights. First half of the year reports and the outlook for 2020. And this one is themed Up in the Air, something that you have to really get onto. It's published in ProShare, and let's give you clarity on the UK-EU economic ties, as well as an accommodative monetary policy stance by central banks across the world would bolster growth in 2020. But against the run of play, against all odds, and not even in the calendar or a diary of anybody, the outbreak of COVID-19 pandemic threw a curveball at all the forecasts, as global attention was shifted to a public health crisis at a huge economic cost. In the second half of 2020, global trade, according to United Capital Research, is unlikely to return to the pre-COVID-19 level, as economies around the world would continue to grapple with the impact of the pandemic on both global demand and supply value chains. Clearly, the initial euphoria that greeted the last-minute US-China phase one trade deal signed in December 2019 has fizzled away. No thanks, of course, to COVID-19, which added a new dimension to the brawl between both countries over China's transparency and information hoarding on the virus. Overall, United Capital believes a rebound in global trade volume is hinged on how soon normalcy will be restored and the pace of economic recovery around the world. Elsewhere, it expects economic policies to remain broadly expansionary to hasten recovery. As such, liquidity in the global economy will be enormous, thereby strengthening risk on sentiment and the flow of capital in search of alpha. In absence of fresh surprises, oil prices are likely to hover from $35 per barrel to $45 per barrel for the rest of the year. With no clear green light on a vaccine breakthrough before the end of 2020, United Capital is of the view that questioning a global recession in 2020 is pointless. The historic lockdown experience in the first half of 2020 has crippled demand and halted supply chains. Hence, the key question to ask is nature of recovery. That's the key question. What will be the nature of recovery? For Sub-Saharan Africa, by far the most vulnerable, yes, the most vulnerable, through the last to be ensnared by the plague, authorities in the Sub-Saharan African region, according to United Capital, imposed one form of restrictions on the movement and economic activities or the other. This worsened the already fragile social and economic conditions of most countries within the region. The informal sector, which accounts for over 80% of total employment according to World Bank, is clearly the worst hit. Again, while the health crisis exposes the vulnerable countries with an aging population and a large number of citizens with underlying ailments, economic costs will be felt the most by the poor SSA countries, which are most vulnerable economically. That's not really good to hear. As such, gross domestic product growth in SSA is projected to contract by 3.2% in 2020, the lowest level in more than 20 years due to the collapse in commodity prices. Take note of that, the lowest in 20 years. Looking ahead, United Capital believes the shape, duration, and size of recovery will vary from country to country, depending heavily on the improvement in the external dynamics and time frame required to bring economic activities back to pre-COVID-19 levels. United Capital notes that recovery will be most strenuous in countries with little or no monetary or fiscal headroom to provide large bailouts for economic recovery amid rising debt profiles. However, the rapid financial support and debt forgiveness from the IMF, other multilateral agencies, will go a long way to help. Beyond 2020, United Capital believes the effective implementation of the now postponed Africa Continental Free Trade Agreement will be pivotal to building economic resilience against future crises. The agreement will help strengthen regional value chains, reduce vulnerability to external shocks, and advance the digital and technological transformation required to accelerate development in the region. Let's get on to Nigeria. For Nigeria, we already know that there is the Economic Sustainability Plan and 2.3 trillion naira stimulus. So United Capital says, what could have been a flourishing year for Nigeria's economy was caught in the web of a global health crisis, which grounded domestic and external economic activities. Already, first quarter 2020 slowed to 1.87%, and the figure for second quarter 2020 is set to come in negative, despite the series of stimulus packages announced by the authorities aimed at easing the impact of the pandemic on businesses and households across the country. Notably, given that the current crisis is on supply side heavy in terms of restriction of movement and business shutdown, it is clear that the demand side responses by both the fiscal and monetary authorities, liquidity injections, will not be enough to prevent an economic contraction in the short term. However, the palliatives and reforms that are being announced may reduce the probability of sliding into a deep recession, or what you call depression or stagflation, or quicken recovery once the incidence rates of the pandemic begins to drop and the economy is fully reopened. Overall, the Nigerian economy may enter a technical recession by third quarter of 2020. You heard that, technical recession by third quarter 2020, after 2 consecutive quarters of contraction in the second and third quarter of 2020, with a chance of early recovery by fourth quarter 2020 or first quarter 2020. Accordingly, we have United Capital has lowered its real GDP growth forecast for 2020 from 2.3% to minus 2.69% in 2020. The biggest downside risk to the above projections remain the possibility of a second round of lockdown, especially if the virus continues to spread rapidly. Now we're talking over 25,000 cases in the country. Thus, this might delay the possibility of an early recovery or a V-shaped recovery to a more strenuous U-shaped or W-shaped recovery. By implication, corporate earnings will be pressured, except for sectors such as healthcare, technology, and household utilities. You've heard that. Healthcare, technology, and household utilities. Also, United Capital's outlook for the headline inflation remains biased upward in second half of 2020, and it expects the headline inflation rate to settle at 13.3% year-on-year in 2020. Pre-COVID-19 expectation was 11.9% year-on-year. On the exchange rate, it believes the odds are in favor of a further Naira adjustment. You heard that? A further Naira adjustment, which may take the official rate to 410 Naira to a dollar. 410 Naira to a dollar to 430 Naira to a dollar by year end. However, it believes that the Central Bank of Nigeria will continue to defend the value of the local units for as long as it can. Thus, concerns around the further adjustments are likely to discourage large-size foreign portfolio investments and foreign direct investment inflows for the rest of the year. When you look at this report from United Capital and the analysis from the FBN Quest Research, oil and gas analysis and trade, they all show you contractions and challenges, but optimistic Nigerians and a very proactive policy approach can really help stabilize this. But indeed, we face challenging times. And to all viewers, we're going to face challenging times in the second half of the year, but just to encourage you that we need to continue to embrace innovation strategy. And like the CEO of Airtel said, businesses must embrace technology and look at local supply value chains. And this, despite all the challenges and the storms we're seeing, the silver lining is that we must continue to hope and trust and work out strategies and platforms that can help us navigate this. Optimism brings the fact that despite negative growth, despite depression projected, at the end, Nigeria may still, from my perspective, grow at 0.5%. I said my perspective, but all the analysis shows that we may either head into a depression or experience a contraction or recession. And that shows that businesses, policymakers, everyone in Nigeria must begin to take responsibility, adjust necessarily because the times ahead show challenges, but we must work together to build a vibrant economy. So I want to encourage you because what you see here today can be very challenging. It's a wrap for this edition, and don't forget to log on to www.proshenji.com to watch your videos, read your news reports and analysis. Also, you can engage us through our social media platforms displaying on the screen. Note that there's a nexus between economy and politics. Therefore, both are interconnected in every nation. Till we come your way again, keep engaging in robust, incisive, and healthy conversations on the political economy of Nigeria. Thank you for watching. Bye for now, and always remember to stay safe.